Welcome to Investing in Startups. I'm Joe Magyer. Our guest this week is Abe Othman, researcher at AngelList. Abe is one of the leading researchers in the venture and startup space, publishing super insightful research on everything from VC portfolio construction to valuation data and returns. We had a really fun, geeky conversation today about check sizes, contrarian thinking, and what Abe has changed his mind about over the last few years. I'm a longtime reader of his research, so I really enjoyed this one. I thought we covered a lot of really interesting ground, and I think you'll have fun listening as well. Please enjoy. I've been reading your stuff for years, so it's great to finally talk shop with the man himself.
Thank you for having me, Joe. It's great to be on.
I thought a good place to start, given, and especially with like seed valuations have been warming up a lot lately, interesting place to start would be to talk about valuation. And how much do you think valuation matters if you're investing at seed?
Yeah, great question. So I think the short answer is not much, provided that I do think there may be, you see some kind of absurd, frankly, seed rounds now where people are raising at hundreds of millions or billion-dollar valuation and calling it a seed round. I am not sure that those extremely expensive rounds will have the same characteristics as sort of the rest of seed. But if you're talking about maybe sub $100 million valuations and you want an assessment of someone's doing a pre-seed at 5 versus someone's doing a seed at 75, there's not much difference in those opportunities. Now, what we think is happening is seed is actually relatively pretty efficient. The company raising at 75 is probably about 15 times better than the company raising at 5. It's one of the challenges I think the asset class is and so on a forward-looking investment basis, neither of that, to one word, first order, neither of those is necessarily better than the other opportunity. It's one of the challenges I think, especially thinking about a signals-driven approach to startup investing, is that people have come to me and they're like, I've cracked the puzzle about how to do seed investing, and it's to only invest in companies that have repeat founders who've had a successful exit. And you're like, cool, yeah. And they're like, what did the data say on that? And you're like, yeah, the data says that is in fact a positive signal. Yeah, I solved it. And it's well, you kind of solved it because that's the company that's raising at 75 or 100 pre, not the company that's raising at 10. So you're right that having a repeat founder with a successful exit is a positive sign for the valuation of a company on a future basis. But you are paying for that.
And it's not exactly a hidden signal.
Correct. Yeah. And by signal, I would say, my interpretation of signal is anything that's in a deck is a signal. So it's, traction, founder bio, team, whatever. But I do think the sort of on a deeper level, I think my kind of world model is that every positive signal is in fact a positive signal, but founders take 90% of the boon of those signals into price. And so if you kind of work that out, on a kind of iterative thought level, it does suggest that the most expensive seed deals should actually be the highest performing because they're essentially aggregating a bunch of little alpha edges from all the positive signals that make it have a high price. Essentially, they're very high priced because of the positive signals, but the signals are not fully priced in. And when you run the analysis with AngelList data, you kind of get that result. The kind of the hit rate of 10x MOIC seed deals, you can kind of see an up and to the right slope as relative valuations increase. It is certainly not strong enough for someone to be I'm only doing top decile consensus seed deals, bro. That's how you get return. It's not that good. But it is there enough that I think it does reinforce the kind of overall view that so someone going to MIT or GSB or having a successful startup or having a great team or having a bunch of traction or whatever, these are all positive things for investment, but they're mostly priced in. And so, there's not combined with the inherent randomness of the seed stage investing asset class, there's not an obvious clear arbitrage that's just lying there to take advantage of by any kind of anything that would appear in a deck.
I think that folks who maybe don't look at pitch decks all day might find it hard to believe that there could be a 13x gap between a 65 pre versus a 5 pre valuation startup. You look at it and you're like, well, how big of a difference can there be? But when you're qualitatively looking at it, or quantitatively, and you're looking at different signals just on founder quality, pedigree, traction, market competition, growth, like all these different variables that would show up. Usually companies that are raising at ballpark 5 million, there are very good reasons why it's priced around there, and vice versa, for the top decile startups that are raising. So I thought that research was really interesting. I also find it fascinating because there are so many GPs, like VCs, who are just dogmatic about, as you kind of alluded to, like people who, hey, we invest in the best founders, period. We invest in repeat founders only. And then you have ones who are like, we only do deals at 10 posts or smaller, and that's dogmatically about it. And what's interesting is, like, actually, you could kind of pick any of these boxes. And so long as you're investing well in any of them, like, you could seemingly do well. But the level of conviction that people have about how their way of doing it is the superior way, when the data, that you put out kind of flies in the face of that, is interesting.
I mean, yes and no, right? Because one of the things that's become really clear, I mean, it feels so dumb to say this, because it's like, you get kind of that the dumb guy, the average guy, the smart guy meme, right? Where I like to think of myself as a smart guy, but right, it's like adverse selection really matters in venture, right? So you have the dumb guy being like, well, is it the founder talk to you first? And then the person in the middle is like, oh, but like it's actually a complex set of factors that come into making a great seed investment. The smart guy's like, yeah, it's adverse selection. So like it actually, in some sense, as a universe equilibrium, sort of makes sense that everyone would be like, that you'd have a bunch of GPs that are convinced that their own weird idiosyncratic area is the right thing to do, because like, you really at seed, given the volume of companies and stuff, you really can't be someone's, top 3 person they email about their new venture for every single startup. And so I think you actually have this like weird matching equilibrium where everyone is like, oh, I'm the person you talk to if you're raising it sub $10 million, or I'm the person you talk to if you're starting a company in Austin. I'm the person you talk to if one of your founders is Canadian. Like, I'm the person you talk to if you're doing, this small molecule biotech in this exact way. Like, you get this, and that's the way to do it. And like that, you actually get this, like, it actually makes sense from a universe perspective that you would have, because adverse selection is so prominent, it actually does not make sense for someone to be like galaxy brained, like, oh, actually, it doesn't really matter what we invest in, so we'll invest in anything. And we're open. If you just send us an email, we'd love to evaluate it. Because like, then you're always someone's like 50th email. And so the only emails you ever get are from companies that people who are the actual sort of domain experts have passed on, and you end up building a terrible portfolio. So I actually think it's funny, because there's like, you are completely correct. On a local level, there's absolutely no reason, like, I'm going to invest in only companies that are, the person who only invests in the most expensive prestige opportunities, and the person who only invests in like companies they view as undervalued or whatever, like they're like ex ante, they're probably both going to have great portfolios, right? But the person who's like, oh, actually, like, I don't even have a niche, because like everything's priced in, so I'm going to take whatever opportunity comes to me. Like, that's the portfolio you don't want, which is, I don't know. It's crazy to think about that as like, there actually is an extreme amount of logic for being irrational in the way that GPs are.
What sustainable edges do you think exist among GPs, kind of with that worldview?
It depends on what you define as sustainable. Because I think sustainability in this weird asset class that we're in is probably more on the order of like 2 or 3 years in terms of anything sustainable. Because I think sustainability is probably driven by network effects more than anything, right? Who really matters. But there's a lot of turnover in these jobs. And, I think about, for instance, my own personal seed investing. Like, I'm not doing any more seed investing, but like, I was like pretty good at it like 8 to 10 years ago. And if you gave me a seed fund now, I don't think I do a particularly good job with it. Like, and then you see also as well, like, it's kind of a progressive, like, folks that do a lot of seed investing and are like kind of the pinnacle of seed investing. And then it kind of like they burn out for whatever reason, right? You saw it with, way back in the day, like way back being like 15 years ago, maybe like there was like Harrison Metal and Google Ventures, and they stopped doing that. more recently, like Founders Fund was like, we had them pegged as one of the very best, most frequent, awesome seed investors. And I guess they stopped doing seed investing. I also kind of wonder at an asset class level if there is something that's just like inherently burnout prone in doing seed investing, because you have such a huge gap between like when you actually wrote the check versus when you see sort of the benefits of writing that check. And I do think like, what you sort of perceive, just speaking to my own personal like seed investing opportunities, like I've spent a lot of time in my life with companies that like didn't go anywhere, that I thought really highly of, that I worked hard, that I like really gave it, didn't really, and I do want like, whereas like the companies that like kind of seemed indistinguishable from the other ones that done really well, like I actually haven't gotten the chance to spend a ton of time with them, probably because they're crushing it so hard that they got to meet other better people really fast. And so it's like, I don't know. I think that dynamic does lead to burnout. I think when we talk about sustainability from seed investing perspective, I think it's a pretty short lifespan. I don't know. Maybe that's a different perspective than you sort of wanted from that question, but it is a very good question. And it's something I think about and I grapple with quite a bit actually in terms of thinking about what sort of seed looks like as an asset class.
I listened to a talk that you gave recently, and one of the things you mentioned, to go back to kind of the valuation decile piece, but also maybe just adverse selection, about being contrarian in startups, and how one element of it that's fundamentally different than a lot of other markets is the need for follow-on funding. And you made a really interesting point around how, while being non-consensus and commonly discussed, being non-consensus and right is the biggest payoff in investing across all spheres. But what's different with startups is, if you're investing in something extremely non-consensus, most likely in 18-ish months, they're going to need to go back and get additional funding. And if it's so non-consensus yet hasn't shifted into consensus by that point, it's probably not going to get funded. And that is a really interesting wrinkle to startup investing. And I'm obviously leading with some of the points you've already made, but I'd love to get you like expanded and rolling on that, because I thought it was a really interesting point.
I think it's one of the most interesting dynamics about seed as an asset class is like, yeah, in general, virtually every startup you invest in will need to raise more money. And the easiest way to raise more money is to be a popular company that has an easy time raising. Like that company is going to have will tend to be the, 2 or 3 years from now will tend to be the easiest company to raise money in the future. Whereas the company that had struggling to raise money now will probably struggle to raise again in 2 or 3 years. And so, yeah, I think, I said this a little bit facetiously, or like I've given talks where I've said this facetiously, but it because there is a tie, and it offends some people, right? Because, ultimately these are financial securities, these are real assets. Like they do tie eventually, hopefully the company does exit or does get acquired or does, IPO or something. There is a tie to the actual real economy. But it's, kind of all the way back, telescoping all the way back to seed. Seed does look a lot more like, the market for vintage Rolexes or cool Air Force One shoes than it does for municipal bonds. And that's because it's a popular consensus kind of perspective on value, as opposed to some objective technical perspective on value. And I think what that means, there's a few aspects to that, but one is like, in a nutshell, that's why being contrarian at seed has very little value, is that if you can't support that company for the amount of time it takes to become a popular idea, which could be quite a bit of time and quite a bit of money, like it's not worth doing it. Because if you go and invest in a bunch of unpopular ideas you think are cool, what you have in 3 years is a portfolio that's going to be staring down a lot of go to zero write downs. And only, there are only very, very rare cases where you see companies that like startup companies sort of figure it out or have enough revenue coming in the door that they like, raising again becomes an option. And then, those are great stories. And those are in fact really huge gainers. But like, I don't think that's sort of not the way I think to handle the asset class. So it is like, I think that's such an interesting perspective. It's like you have to go finding the companies that other people think are popular is a really good way to do it. And I think it's one of the things that's sort of coming at this asset class from the perspective of a startup founder. I was always super irritated by meeting VCs and having them just be like, well, who else? Like it was so cagey, right? Like either at the sort of, they would ask at the start of the meeting or they'd ask at the end of the meeting, they'd be like, well, who else is investing? I actually came to prefer when VCs would ask it at the start because at least it felt much more like transparent. Whereas like you would spend, 45 minutes going through your plans and your go-to-market and like your progress so far and how that pilot's going and like how close are you to the contract and like, can this tech really scale? And then at the very end, who else is investing? Like clearly that was the thing they were thinking about. Like it just, they weren't paying any attention. They didn't care about your company. Who else? That was the thing they came to ask. I would love to have data that would suggest that that's, an awful lazy way of doing venture capital. And in fact, the data points that is actually like trying to ferret out a common signal by understanding who else thinks this is a good idea is in fact a really fantastic way to do seed stage investing. And that the VC who looks like a lazy frat bro is actually really like that is the correct way to handle venture investing, which it's been kind of sad, frankly, getting that result from the data. But it has, in kind of my 7 years at AngelList, I think my perspective has really shifted from one in which I thought VCs were really dumb and bad at their jobs and that, we just need the appropriate amount of data to like prove how bad VCs are at their jobs, to one where I actually grudgingly have gained a tremendous amount of respect for VCs, specifically seed stage VCs for doing the really, really challenging job that they do actually.
On behalf of all seed stage VCs, we'll take that. Thank you. I'd love to talk about an awesome paper that you wrote on check sizing. We were talking about it before the show. There were multiple really interesting insights coming out of it. Maybe start with the headline one, which was that small checks, relatively small checks from VCs outperform other checks they write. And maybe we could start there. You could speak to why that's the case.
Yeah. So I think this is one of the things that has sort of reinforces my, again, low like vintage Rolex perspective of what seed stage investing is, which is that like in a normal asset class, in a normal kind of financial market, you have this idea where you essentially scale check sizing to quality of opportunity. So, if you have a really, really good opportunity, you'll sort of, absent other constraints, you'll come in at size. If your opportunity, you perceive it as being a little bit less good, you'll write a smaller check. This goes back to like the start of quantitative finance. That's really like the Markovitz portfolios are really about how you scale check sizes given risk and reward. The Kelly criterion, which I love, and a lot of people who do this stuff love, is around scaling checks so that you put less money behind worse opportunities and more money behind better opportunities. And like, in some sense, that's sort of what I expected to find when we were looking at the AngelList data. So one of the cool things about AngelList is that we can do this research. I'm like, okay, let's take a look at every GP who did at least 5 seed investments in a given year and try to understand what a big check size would be for them. As opposed to like using anecdotes, we can do, hundreds and hundreds of GP year examples as our input data for this, which is like essentially a large enough slice of the universe that we think that there's not really another conclusion that you can draw. And so the question is like, you'd expect naively, or if seed investing was like a normal asset class, you'd expect small checks to do the worst because like, I think pretty highly of our GPs. I think they're like pretty good at their jobs. And I would assume that they'd be able to assess, quality decently. And so if you assume like, okay, small checks, worse opportunities, those should be the worst performing. And in fact, what we found is that like, those are in fact the best performing checks. And the reason small checks are the best performing is because they're in some sense actually a very high conviction signal. So what we mean by small checks in this context is that it's less than half of a GP's typical seed check that they'd write in that year. So again, a normal, I write 250K checks. This is a company I'm only writing a 100K check to. The reason why a GP would write a 100K check in that company is actually one reason, the naive reason would be, well, they think it's an okay but not great opportunity. It's worse than their typical opportunity. We'll write a small check. The actual reason they're writing a 100K check is they asked the founder for 250K allocation and they got crammed down to a 100K check. And actually, like, they feel strongly enough about this company that they're like, okay, I'm willing to take the 100K check, even though I really want to be writing 250K checks. And so actually, it's like the actions of other people are causing them to write a smaller check, and that those smaller checks, because they carry this sort of consensus signal for being a hot deal, they're popular. Again, going back to the idea of like, yeah, the company that you'd expect to have an easy time raising money in 3 years is the company that's having an easy time raising right now. There's no better indicator that a company's having an easy time raising now than they actually have to turn down money from people who are like, who want to invest. And so, yeah, I think the small check thing is very, very counterintuitive in the sense of like, it does not align with a typical outcome for a typical financial asset, but is definitely in the data, and it is also in some sense, like if you think, I tend to think about the universe as pretty efficient. And so like, you should always be skeptical if you're like, this is a source of alpha, because in general, sources of alpha tend to be exploited. And this is a source of alpha that can exist, right? Because it's like, the things that you should be putting more money into are the things that you cannot put more money into. Like that's fine. Like I've not broken the universe and created and we're not like suggesting there's some like magic money pump here, because so in some sense, the outperformance from small checks is like allowed to exist in a universe with no arbitrage conditions. So yeah, I think it's an interesting result for sure.
I think that leads to a natural segue into the large check piece and the takeaways that you had from that side of the research as well. Would love to hear about performance of large checks and how that shook out relative to your expectations.
I think that's actually maybe even a more interesting side is large checks, because, again, small checks can be a little bit complicated, right? Because there's a lot of reasons why someone might write a small check, right? Maybe they do actually not feel as good about the company or whatever, but there's only one reason someone write a large check, and it's that they have a bunch of conviction. So again, like large check here means more than twice as much as a typical seed check you write in a year. So you typically write 200K checks. You're writing a 500K check to this startup. I think the GPs we look at are pretty good. I would trust them that they like, when they think something's a good investment, like I would be like, oh, it's probably a good investment. What we found was that large checks were pretty much identical performing to typical size checks. And the conclusion from that is like a couple, like it suggests that any sort of idiosyncratic signal that a GP gets about a company that makes them want to write a big check is like countered by the fact that that capacity was there for them to take in the first place, that a better investor didn't take that capacity. And so it opens up the opportunity for a GP. Like, I think that to me is like a really fascinating result, because it suggests that like here between the small checks and large check results, what we have, this shapes the universe, right? It suggests that idiosyncratic signal, I want to write a big check in this company because this is like, I know this area really well, and this company is the company that's going to win it, matters zero. And common signal, which is like, who else is investing in this deal, bro, is the thing that really matters for future returns. And so, that's really this paper on something that seems like kind of innocuous, right? Check sizing is actually like, I think, quite significant in terms of what it reveals for the asset class, and really is why I think it's much closer to vintage Rolexes than it is to a normal financial asset. So it is surprising, but there's some implications from that in terms of thinking about, okay, if idiosyncratic signals don't matter, I think the kind of broader project of a quant disruption to startup investing will never happen, or won't happen from the same way that systematic investing has disrupted traditional financial assets. And it's because the idea of like getting your team of quants to like figure out these cool signals based on proprietary data, and then like investing idiosyncratically to like find the undervalued opportunities is like that's not the way seed investing works. There is data that would be really valuable to help seed investing, but that data is like, who are the companies that are meeting a lot of VCs right now and getting a lot of term sheets, and like try to invest in those companies. Like that's the data that would be useful, not, we have like satellite data that's looking at parking lots. Like that's not what matters at seed.
Is it possible that the lack of edge or alpha or outperformance on the large check could be some kind of middle ground between, to the positive, you would think if there's outsized conviction or expertise, you would think intuitively that should show up in better performance on that check. But the signal or the The implication from small checks performing so well as a result, most likely, of rounds being very competitive in the signal with that. Like, is it possible those things kind of net out as far as there's straight adverse selection on the capacity for a large check? But on the other hand, the netting out piece is like, well, maybe there is a lot of conviction here and there's a positive to that. And it just kind of lands at where a typical one does.
Yeah, I think that's what's happening. I agree. Like the idiosyncratic thing is not a purely negative because it's not like large checks were worse, but they're not better. And so I do think there is a netting out. Like you have the two factors. One's positive, one's negative. Whatever, they are more or less canceling each other out. I think that is what's happening. But yeah, if you had to pick one, would you rather do a seed stage investment that you really believe in, or a seed stage investment that everyone really believes in? It's better to go for the one everyone believes in, which is like, yeah, I mean, that's interesting, right? Like, that's certainly like, yeah, that's an unusual finding for an asset class.
You kind of alluded to a couple times your opinions change on different ideas, perspectives over time. And you mentioned, with the small check piece, when you publish that, so like I actually don't know that I love the conclusion of this, but I love that you put it out anyway. And you're running with that and put it out in the domain and helping investors and founders be better informed with it. What are those internal or monologues like when you do a deep piece of work? The result is like, oh, bummer. But there's a great insight here. But I guess this isn't what I was hoping for. What does that look like?
Yeah, that's a good question. I feel like, so I did my PhD at Carnegie Mellon in Pittsburgh. Like I want the results. I would love for the results to be like, oh, Pittsburgh has all these exciting startup opportunities. We need to look beyond the Bay Area. There's so many undervalued companies. It shouldn't just be a cabal of Stanford frat bros that are like controlling this asset class or whatever. Like, I'd love for the results to be pushing in that direction, and they're just not. I do have a PhD. I feel like I have an obligation to, kind of report the truth as we can best find it. But on a personal level, it has been kind of like a little bit disturbing to see so many of the like what I perceived as like the negative things about the asset class actually come out as being totally rational in the data. I've had some of these things where we were looking at illiquidity in the asset class or something, and like I got this like result. I still remember this because it's such a bad feeling from it. I got this result that like, oh, according to this data, like good seed investors are sitting on a highly appreciated portfolio that's not really growing in value and just praying for exits. And then I thought for a second, and I was like, oh, that's my portfolio. Oh, good. It's I don't know. I guess to be most charitable, it's a testament to the quality of the data set that I have the privilege of working with, that I get results that depress me. It is tough. Like I sort of wish, yeah, I mean, I wish the world were a certain way. It doesn't appear to be from our data. But I do think we have an obligation to sort of report on that. I do think like, I kind of wish that we had more, contrarian results some of the time, because I feel like a lot of the results I found from the data actually do align pretty well with like conventional venture wisdom. And so it's like, it's not really a net positive to the universe for like what we've done. Cause it's or like people are like, oh, like it's hard to get headlines about the research because it's like, oh yeah, everyone knows that though. And you're like, well, yeah, but I like, empirically validated it based on this enormous data set. And everyone's like, yeah, but like that dude said that one time. So, it's true. So I think that is like a little bit of a challenge when we think about data driven stuff. I would love to.
Yeah, I feel like I kind of took us down like a little bit of a dark path with that question. To flip around, is there an insight result from your research that came out that you were like, love it. This makes me so happy. I look forward to sharing this, and this is great.
Yeah, I think it goes back to my first kind of big result from Startup Growth and Venture Returns, the white paper we wrote back in the end of 2019 about suggesting that I think that early stage venture is actually three asset classes: seed, Series A and B, and kind of like B and beyond. And those asset classes corresponded in this paper. We suggest that those asset classes correspond to breakpoints of the alpha parameter of the power law of returns from investments. And essentially, like seed has an alpha less than 2 power law with these really, really wild outcomes. Series A and B-ish is kind of like intermediate alpha parameters between 2 and 3, undefined variance, defined mean. And then later stage investing is, depending on kind of like, it looks sort of like maybe a slightly more wild public markets. Actually, of those three assets, and like what's fascinating, super interesting about this asset class is that like if you're a good seed investor, your investment actually goes through 4 different asset classes, right? It goes from seed to Series A to like late stage to public. Like you get to go on this crazy journey where with different attributes, and it's like, you don't just get to buy a municipal bond. But yeah, I think that's the most interesting result. And the implication of that is like really, like people hate I love it because that's the one super contrarian thing. People hate the result, or at least find the result to be irritating in a way that I love pressing on, which is that, like it's almost like a trick question, right? Would you rather have a portfolio of 10 companies with larger checks or 100 companies with smaller checks? And like, people are like, well, actually, they should be around the same expectation, but maybe there's a question about variance. And you're like, nope. Like the implication of an alpha less than 2 power law is that the sample mean increases in N. So it is actually, we believe, like the implication of this all is that you should actually get a higher sample expectation from the 100 investment portfolio than 10. And people are like, that's not possible. In general, that's true because of the linearity of expectations, but the alpha less than 2 power law has this magical property where it does not have a defined expectation, and therefore it is not subject to the linearity of expectations. And so you get this crazy result where you make more investments, you should get higher average returns, which is like, what that means is that it is absolutely unequivocal. Bigger portfolio is better at seed. Like, I think that to me is like the real kind of controversial finding because people like concentrated portfolios.
I normally end the show by asking what's a conventional view in venture that you think is BS, but I feel we've covered 10 of them today. So I don't know that you need to throw another on. But Abe, this is great. I enjoyed talking to you so much about this stuff. And yeah, thanks for coming on. Thanks for all the research you put out and do for the ecosystem.
Yeah, I feel so privileged to get to sit on this giant data set of these outcomes. It's a really cool thing I get to work with. And I sort of view the research as a way of sharing some of that boon with the larger community, because I think there are some cool lessons that we can learn from the data. And I love finding them and I love sharing them. And to you or to any of the readers or listeners of the podcast, like, if you want to shoot me an email, if you have a question, you think we answer in our data, shoot me an email. I love when people have ideas for stuff that, maybe our data set can kind of uniquely answer.
Thanks for listening to the show. If you're enjoying it so far, please tell a friend or give the show a 5-star rating. It helps. One more thing. Investing in startups does not have sponsors, but I want to give a shout out to one of our portfolio companies, Packsmith. Packsmith is the all-in-one e-commerce platform built for brands. With unparalleled transparency into your fulfillment operations, unique packaging customization options, and up to 80% faster delivery at rates your 3PL could never match, Packsmith is the logistics solution built for the future of e-commerce. If you're a growing e-commerce brand on Shopify looking to optimize your brand's distribution and sales for scale, head to packsmith.io to learn more. Thanks again for listening.
Joe Magyer is the founder and managing partner of Seaplane Ventures. The content here is for informational purposes only and should not be construed as investment, legal, or tax advice. The opinions expressed by guests are their own and do not reflect the views of Seaplane Ventures. Our host, guests, and clients may hold investments discussed in this podcast. Please invest responsibly.